the petrodollar. A term that might seem simple at first glance, but it encapsulates a complex and far-reaching system. This simple term encapsulates a complex system that has underpinned the global economy for half a century. It is a system that has influenced the rise and fall of economies, the stability of nations, and the balance of power across the globe. It represents the pricing and trading of oil, the world's most vital commodity, exclusively in US dollars. This arrangement has created a unique interdependence between oil-producing nations and the United States. This seemingly technical arrangement has had profound geopolitical and economic consequences, shaping the destinies of nations and influencing the flow of trillions of dollars. The petrodollar system has been a cornerstone of international finance and diplomacy. Oil, often dubbed black gold, fuels our modern world. It powers our cars, heats our homes, and is a critical component in countless products we use daily. From transportation to manufacturing, its importance cannot be overstated. The global economy is intricately linked to the availability and price of oil, making the petrodollar system a linchpin in international trade. The petrodollar system, established in the 1970s, ensured that every barrel of oil traded on the global market was priced and paid for in US dollars. This agreement was a strategic move that solidified the dollar's dominance in global trade. This created an insatiable demand for the greenback, cementing its status as the world's reserve currency. Countries around the world needed to hold large reserves of US dollars to pay for their oil imports. The petrodollar's influence extends far beyond energy markets. It has impacted global financial systems, international relations, and even military strategies. It has provided the United States with unparalleled economic and political leverage. The ability to control the currency in which oil is traded has given the US a significant advantage on the world stage. The ability to print the world's reserve currency has afforded the US significant advantages, including lower borrowing costs and greater flexibility in managing its economy. This has allowed the US to maintain a level of economic stability and growth that might otherwise be unattainable. However, the winds of change are blowing. The global economic landscape is shifting, and with it, the foundations of the petrodollar system are being questioned. Recent events suggest that the petrodollar's reign may be coming to an end. Economic and political shifts are challenging the status quo, and new alliances are forming. Saudi Arabia, the world's largest oil exporter and the architect of the petrodollar system alongside the US, has signaled its willingness to trade oil in other currencies. This potential shift could have far-reaching implications for the global financial system. This move has sent shockwaves through the global financial system, raising questions about the future of the US dollar and the existing global order. The end of the petrodollar era could usher in a new phase of economic and geopolitical realignment, the effects of which are yet to be fully understood. To understand the potential implications of a world beyond the petrodollar, we must first delve into its origins. The petrodollar system has been a cornerstone of global finance for decades, influencing international trade, economic policies, and geopolitical strategies. Its roots, however, are deeply intertwined with the historical events of the mid-20th century. The story begins in the aftermath of World War II with the establishment of the Bretton Woods Agreement in 1944. This landmark conference, held in Bretton Woods, New Hampshire, brought together delegates from 44 allied nations. Their goal was to create a new international monetary system that would foster economic stability and prevent the kind of economic turmoil that had led to the war. This agreement aimed to rebuild the shattered global economy and prevent a return to the protectionist policies that had exacerbated the Great Depression. By establishing a framework for international economic cooperation, the Bretton Woods Agreement sought to promote free trade, economic growth, and financial stability across the globe. The Bretton Woods system established a fixed exchange rate regime, pegging the value of major currencies to the US dollar, which in turn was convertible to gold at a fixed rate. This system provided a stable foundation for international trade and investment, as countries could rely on predictable exchange rates and the stability of the US dollar. This system effectively made the US dollar the world's reserve currency, reflecting the United States' newfound economic dominance in the post-war era. The US, with its vast industrial capacity and significant gold reserves, was seen as the anchor of the global financial system. However, this system began to unravel in the late 1960s and early 1970s. The economic landscape was changing, and the fixed exchange rate system was increasingly under strain. Rising inflation in the U.S. and a growing trade deficit put pressure on the dollar's gold reserves. The U.S. was spending more on imports than it was earning from exports, leading to a depletion of its gold reserves. This imbalance threatened the stability of the Bretton Woods system. In 1971, President Richard Nixon took the U.S. off the gold standard, effectively ending the Bretton Woods system and ushering in an era of floating exchange rates. This move, known as the Nixon shock, marked a significant shift in global economic policy, as currencies were now free to fluctuate based on market forces. The 1973 oil crisis further exacerbated the situation. The sudden spike in oil prices sent shockwaves through the global economy, leading to inflation and economic stagnation in many countries. The Organization of Arab Petroleum. Exporting countries, OPEC, imposed an oil embargo on the U.S. and other Western nations in response to their support for Israel during the Yom Kippur War. This geopolitical maneuver highlighted the strategic importance of oil and the vulnerabilities of oil-dependent economies. The embargo sent oil prices skyrocketing, creating economic turmoil and highlighting the West's vulnerability to energy shocks. Long lines at gas stations, soaring fuel costs, and widespread economic uncertainty became the new norm. It was in this context that the Petrodollar system was born. The need for a stable and reliable currency for oil transactions became apparent, and the U.S. dollar was poised to fill that role. In 1974, the United States and Saudi Arabia, then the world's largest oil producer, struck a pivotal agreement. This agreement was not just about economics, it was a strategic alliance that would shape global geopolitics for decades to come. Saudi Arabia agreed to price and sell its oil exclusively in U.S. dollars, ensuring continued demand for the greenback even after the collapse of the Bretton Woods system. This arrangement created a symbiotic relationship between the U.S. and Saudi Arabia, with both nations benefiting from the stability and predictability it provided. In return, the U.S. offered military protection and support to the Saudi regime. This military backing helped to secure the Saudi monarchy's position and ensured the uninterrupted flow of oil to global markets. The petrodollar system thus became a cornerstone of U.S. foreign policy and economic strategy, influencing international relations and economic policies around the world. The petrodollar system had far-reaching consequences, shaping the global economic and geopolitical landscape for decades to come. It was a system born out of necessity and strategic foresight, intertwining the fate of oil with the dominance of the U.S. dollar. This arrangement not only influenced international trade, but also dictated the flow of global investments and economic policies. For the United States, it cemented the dollar's status as the world's reserve currency, conferring significant economic and political advantages. The dollar became the bedrock of international finance, a currency that nations trusted and relied upon. This trust translated into unparalleled influence, allowing the U.S. to shape global economic policies and maintain a stronghold over international financial institutions. The global demand for oil translated into a constant demand for U.S. dollars. Every barrel of oil sold on the international market required dollars, creating a perpetual cycle of demand for the currency. This demand was not just a matter of convenience, but a strategic necessity for countries dependent on oil imports. This allowed the U.S. to run large trade deficits and finance its spending at lower interest rates. The ability to borrow cheaply and spend freely without immediate economic repercussions was a luxury afforded by the petrodollar system. It enabled the U.S. to invest in its infrastructure, military, and social programs, further solidifying its global dominance. Foreign governments and central banks accumulated vast reserves of U.S. dollar assets, further bolstering the dollar's dominance. These reserves acted as a buffer against economic instability and provided a means to engage in international trade and investment. The accumulation of dollar reserves became a symbol of economic stability and strength for many nations. Moreover, the petrodollar system gave the U.S. significant leverage over other countries. This leverage was not just economic, but also political, allowing the U.S. to influence global policies and decisions. The ability to control access to the dollar and the U.S. financial system became a powerful tool in international diplomacy. Since international transactions, particularly in commodities like oil, were conducted in dollars, the U.S. could exert economic pressure through sanctions or by threatening to cut off access to the U.S. financial system. This economic pressure could be used to achieve political objectives, making the petrodollar system a cornerstone of U.S. foreign policy. The petrodollar also played a crucial role in shaping global trade and investment flows. It created a network of economic interdependence, where countries engaged in trade not just for profit, but also for access to the dollar. This interdependence fostered a global economic system that was both complex and interconnected. The need to access dollars for oil purchases created a natural incentive for countries to export goods and services to the U.S., further strengthening its economy. This export-driven relationship benefited the U.S. by providing a steady stream of goods and services while also supporting global economic growth. This system, however, was not without its critics. Some argued that it created an uneven playing field, where the U.S. enjoyed disproportionate benefits at the expense of other nations. Critics pointed to the inherent imbalances and the potential for economic exploitation. Some argued that it gave the U.S. an unfair advantage, allowing it to live beyond its means and export inflation to other countries. The ability to print dollars and use them to purchase real goods and services from other nations was seen as a form of economic imperialism. Others pointed out that the petrodollar system contributed to global imbalances, with oil-exporting countries accumulating vast surpluses, while oil-importing nations grappled with deficits. These imbalances created economic vulnerabilities and tensions, highlighting the need for a more equitable global financial system. While the U.S. dollar remains the dominant reserve currency globally, there has been a gradual diversification trend among countries. Central banks have been increasing their holdings of other currencies like the euro, yen, and Chinese yuan. This diversification is driven by geopolitical tensions, economic sanctions, financial crises, and the desire to reduce dependence on the dollar. However, to date, the dollar still constitutes the largest share of global foreign exchange reserves. The value of a currency can be falsely bolstered through several mechanisms, creating an illusion of economic health. First, artificial demand can be created. Governments or the Federal Reserve can purchase large amounts of U.S. currency or other assets to increase demand and prop up the value. The Federal Reserve primarily influences the value of the dollar through monetary policy tools such as raising interest rates, which can strengthen the dollar by attracting foreign investment. The Fed also buys and sells government securities to influence money supply. Occasionally, the Federal Reserve intervenes in currency markets in cooperation with other central banks. These actions indirectly affect the value of the dollar by influencing economic conditions and market perceptions. Manipulating our currency can have several adverse effects. The primary effect is inflation. Excessive printing of money can lead to inflation, reducing purchasing power. Artificially low rates can create asset bubbles in housing or stock markets. Misaligned currency values can distort trade balances, leading to deficits or surpluses. Lastly, frequent interventions can create instability in currency markets. These factors can destabilize the economy and lead to long-term financial issues. So where is the U.S. dollar? The U.S. dollar remains the primary reserve currency for many countries, but several countries are seeking to diversify and move away from the dollar. China is reducing reliance on the U.S. dollar by increasing holdings of euros, yen, and other currencies. Russia is increasing their gold reserves and euros, decreasing U.S. dollar holdings. India is diversifying reserves to include more euros and yen. Brazil is shifting to a mix of currencies, including the euro, and individual countries within the European Union are also diversifying into other currencies and assets. In conclusion, as countries diversify their reserves away from the petrodollar, the U.S. dollar could face decreased demand, reduced global influence, and increased volatility. These changes can lead to economic imbalances and undermine the long-term stability of the dollar. While the U.S. dollar remains dominant, these shifts in global financial strategies highlight the need for the U.S. to adapt to maintain its economic influence and currency stability. If the world is going to move towards a new gold-backed currency, we have been told that the U.S. dollar would need to crash. While current economic indicators do show a weakening and various countries seek to diversify their reserves, the dollar is still relatively strong on paper. For this reason, it's difficult to determine how close we really are to a monetary reset, because the value of the dollar remains relatively strong. We'll just have to watch closely and perhaps speak to an expert if we have a lot to lose by a sharp downturn in the stability of the dollar.